Okay, everybody, good afternoon. Before we get started, can I get everyone to make sure your doors are shut and your other devices are turned off? I'm going to cover quite a bit of information in a short period of time, so I need your full attention. Also, everyone on this call will receive a copy of this training and the material at the end of the broadcast. My name is Chris Duffield, and I'm an account executive for New Line Mortgage. And this class is the last class in a series of trainings we've put together designed for loan officers that are either new to VA purchase loans or need a refresher. So for about the next 30 minutes, we're going to cover the submission, the underwriting, closing, and funding process of the loan. Also, before we get started, I'd like to take a moment and ask for your business. As an AE, I'm paid commission, so the best compliment you can give me is to send me a loan. If you find this training useful and learn something new, please send me a loan on any product. New Line offers some great FHA, VA, conventional, and USDA pricing right now. And I have many other trainings available on this product, or if there's any specific training you need, don't hesitate to contact me. We can put something together. Okay, let's go ahead and get started. So, the underwriting process. I'm assuming that most of you have had some kind of exposure to the underwriting process and understand that a loan must be submitted to a lender or an underwriter for approval. And typically when a lender approves a loan, it comes with conditions. These conditions are documentation requirements that must be satisfied, and there's 3 different types of conditions. You have the underwriter to clear conditions. These are conditions that affect the outcome of the loan. They typically have to do with income, credit, liabilities, or assets. And an underwriter must sign these off. And then you have prior to closing conditions. These conditions can be signed off by an assistant and are typically QC conditions that are completed right before closing. They typically have to do with verbally verifying employment, reviewing the homeowner's insurance, processing your closing document request form, and, maybe pull an LQI and run a MERS and all of that. Then you have prior to funding conditions. These are conditions that are satisfied at closing, and typically the closer can sign them off when reviewing the package for funding. Just so you know, New Line typically doesn't have prior to funding conditions. Between my underwriter and my closing coordinator or loan coordinator, Jill Hovat, we typically get all the conditions, we require and get all the conditions signed off before closing. That way when the loan closes, it funds the next day without issue. All conditions should be worked on immediately. Ultimately, they're your responsibility, even if you're not responsible for completing them. So take ownership of the conditions, whether you're completing them or not. Call into your lender for New Line, call in to Jill Hovat, our coordinator, and ask her, where she's at on her conditions. Don't be afraid to take responsibility of the conditions and make sure that they're getting done. Make sure you're in communication with your lender and that each of you understand who's working on what condition. Don't assume all lenders work the same. Make sure you understand each condition and what the lender expects from you and what you can expect from the lender. So before you submit the file, you notice we just kind of talked about conditions. I want to talk about a little bit more about conditions and more about avoiding them and the importance of submitting a complete file so that you do limit conditions. There's only a few things you can do, well not only, but there's a few things you can do to limit the conditions. But before that, let's talk about why it's important. An underwriter is required to have a piece of supporting documentation for every bit of data in the file. If the data is not documented, it's considered invalid. Sometimes we call it a rumor. The documentation must stand on its own as it travels with the file, and it's what secondary market uses to determine if they'll buy the loan or not. They don't call us or you. They don't call the borrower or the borrower's employer. They don't do any research on the internet. They simply refer to the documentation in the file. So it's very important that everything be documented on paper. Like I've stated, every little piece of data has to be documented. And then when the file is sent into an investor for approval, typically the file is scrubbed by an entry-level person using a checklist. If something isn't there or is incorrect, they simply return the file as non-purchasable. And literally they do. They'll go through a checklist and they'll mark things off, and if something isn't there, they don't do any further research. They stop right there and they send the file back as non-purchasable. It's very hard for us to deal with, and sometimes us and lenders can dispute these findings, but sometimes we can't. You know, we've even flown people out to our investors and sat down with them to go over non-purchasable loans. But this is a painstaking and costly process. So how we avoid this is we make sure we're only submitting complete loans to our investors. What we have to underwrite for, and what the file has to demonstrate, is the borrower's credit history, which includes their FICO and their credit report and a review of their liabilities. The borrower's capacity to repay the mortgage, so we're reviewing their income, their employment, their assets, and their ratios. And we're reviewing the collateral, which is the appraisal and title. These are known as the 3 C's of underwriting. If anybody ever says that, that's what they are. It's credit, capacity, and collateral. And just so, just to kind of point out, collateral, your property is 1/3 of your approval on your loan. So it plays, a very important part in the approval. We're not just checking that the property is a single family or how many units it is. It's got to be marketable, the value's got to be there, and it has to meet certain requirements. So anyway, those are the 3 C's. And in there's a lot of guidelines and statutes and rules. It's a huge endeavor, actually, to underwrite a loan these days. Underwriters must know all the different program guidelines, not only the LTV and the FICO requirements and what the requirements are for 1 to 4 units, the different requirements for occupancy type. They have to know what documentation requirements to ask for all the different scenarios that we work with for income, employment, assets, liabilities, identity of interest, max allowable costs, and a myriad of other requirements and guidelines. And not only do they have to know these guidelines, they have to know them for the different investors and warehouse line providers that we have, and they need to understand all the overlays that come with those. There's a lot that goes into an underwrite. It takes a minimum of 1 hour to underwrite a loan. It's not an easy process. It takes a minimum hour to underwrite a loan with multiple conditions or hard conditions. It's kind of how we got started on this. We were talking about conditions, and we could see a lot of them. There's a lot of guidelines to follow. And our industry isn't advanced enough yet to come up with a system an underwriter can use to help them underwrite a file. I mean, there's not a system for any of us to use to help us underwrite a file. You would think with all the technology there'd be a central database, there'd be some kind of a software system where you could plug information in and it just underwrites the file for you. It's not there. The thought process is largely manual, and the tools are cumbersome. And they're spread out. They're all over the place. All of our investors' guidelines, warehouse provider guidelines, overlays, etc., are not stored in one easy system. They're all over. So it's tough to underwrite a loan, and it does take time. And it does take time to review loans with a lot of conditions. So you can help the process along by submitting a well-processed and documented file. You should know the information. It's generally considered by lenders and underwriters that a licensed LO and processor should know RESPA, HMDA, ACOA, as well as the program that's being sold to the borrower. So, we kind of understand that You guys as licensed originators and have gone through, many trainings and have kept your license, that at the very least you should know the statutes of our industry. And, you're out there selling programs and pre-qualifying borrowers, that you should understand the program and the guidelines with that. Most broker agreements state that it's the responsibility of the broker for this information, and it's the responsibility of the broker to deliver, well-processed files that meet all the individual statutes and the underwriting guidelines. So there is some responsibility there for you guys to know the industry and know the guidelines. It's also generally considered that it's the LO's processor and the LO and the processor's responsibility to gather and review the appropriate documentation and not wait for the underwriter to ask for it. So, we're looking for you guys to not only know the guidelines, but to ask for the proper documentation, review it yourselves, answer your own questions, and submit a complete file to us. Now, we also understand that there isn't any place you guys can go for central training as well. This industry is unique in that, you have a lot of expectations and requirements from your lenders, but there's really no place where you guys can go for centralized training. You can't get a degree in the mortgage industry. Things change all the time. All investors are different. So I'll talk about some things you guys can do to kind of help with that. But before that, let's talk a little bit about maybe some of the repercussions if you're submitting incomplete files. And when I talk about these, I'm more or less focused on if you're continually submitting incomplete files. A file here and there that's incomplete, we can chalk that up to learning curve, and we're happy to help you. There could be, though, some detriment to even that one incomplete file, but there's definitely some detriment if it's more of a habit to submit incomplete files. So let's kind of talk about some things that can happen if you're submitting complete files. And I've boiled it down to about 4 things. First of all, when you're submitting an incomplete file, you get a lot of conditions. Rarely, if a loan has a lot of conditions, does the rest of the process go smoothly. A lot of conditions mean that the underwriter has a lot of questions. And generally, about 50 to 75% of the underwriter's questions are answered upon reviewing the first set of conditions. So you submitted your loan. Let's say you get 20 plus conditions. You gather what you think is all of the conditions, you resubmit them, and we review them, and at the end, we're still looking at maybe 10 to 15 conditions on that file. You had 20 plus, you've chiseled off, a quarter of those, and we're still looking at 10 to 15 conditions. Maybe now the underwriter has even more questions, so there's new questions, new conditions. It just leaves a lot of unanswered questions, and often more condition requirements are a result of questions being answered a few conditions at a time. We call it breeding conditions. And I've seen loans go from a pre-approved status to suspended or declined because of this. So that, it's definitely one thing to consider when you're submitting an incomplete file. You also don't get a complete underwriting decision. I've seen underwriters miss important guidelines and income documentation requirements because there is so much going on with the file. I've seen loans go from approved to suspended and declined because of this. When an underwriter, has a huge question on income, a huge question on the source of assets, maybe we're dealing with a unique property, we can get some very hard loans in there. And if there's if their attention is being drawn in a lot of different directions, they're human just like us, and they will miss big items, and it will have an impact on you. I did have a loan recently where the underwriter, because this loan literally almost had 30 conditions, and the underwriter missed asking for documentation for child support. So there's child support income in the file being used to qualify. It was in the DTI. I think it's pretty standard in the industry that we know we need to document a history of receiving child support. It might vary per lender or file, but most of the time it's a 12-month history. If the loan officer didn't get the information, the processor didn't get the information, the underwriter didn't ask for it. And we spent almost 60 days on the file underwriting it, and there was another big concern in the file that we were all focused on, and everybody was focused on that. Nobody thought about documenting the child support income. And then when the underwriter and my broker coordinator were going through QCing the file, getting it ready for closing, they noticed they didn't have income documentation in there. And it turned out to be a huge endeavor because the source of the child support was from 4 different sources, basically. And we ended up not being able to use income from 2 of the sources. So it completely changed the outcome of the file. And it took a 60-day process, to almost to another 30 days. And we ended up switching programs, and borrower had to come in with down. We went from USD to FHA. So it was huge, So, just know that if you know we need something, make sure you get it into us, do your own QC, do your own underwrite, and just try and submit a complete file to avoid situations like this. They will happen from time to time. Another thing that can happen if you're submitting incomplete files is you just don't get good service. Knowing issues 1 and 2 exist, lenders are far less happy and willing to provide fast service on files that have a lot of conditions. They're not quote-unquote happy because they know that every time an underwriter reviews a file, it's costing them money. And underwriters are expensive. They're one of the most expensive expenses an underwriter or a lender has to deal with. That's why they come up with guidelines like putting incomplete files back in line. Like it's kind of what New Line does, our way of managing incomplete files. If we underwrite a loan and we have a lot of conditions and you guys submit those conditions, we actually put that file back in the underwriting line. We don't put it in the condition line. So you don't get condition service. You get the underwriting turn times. And other lenders have other, stop gaps they put in place to help manage that. So when lenders do that, just know they're trying to manage, cost as well as workflow because, we're working in a queue and there's other loans possibly ready to close that we'd like to get to before this one. So, so that's why, you might have lenders having different workflows for different types of files. Also, if an underwriter moves too fast, then we risk an unsaleable loan, which costs even more money. And unsaleable loans come back on you guys as well. So if and it's in the broker agreement, that brokers have to help us with unsaleable loans. If we were to let that example I just talked about, if we would have closed that, tried to sell it to an investor, and they're like, hey, we can't buy this, you haven't documented income, we would still be coming back to you guys and either asking for the income documentation. If we end up with a completely non-saleable loan, we'd try and work on a refinance and get it off our books. But just know that you guys would be involved in the process, and basically all the money we've made on this loan is lost the more time we spend working on it. We're all self-employed, and the more hours we spend on a loan, the less hourly wage we're making. So, lenders have to impose some kind of a stopgap to manage their pipeline because underwriters do need time to do their job and get reacquainted with the file so they don't make mistakes. And it's ironic because most of the files with a lot of conditions turn into rush files because they've taken so long to get through underwriting. The other thing that can happen is you don't earn a good reputation with your lender. So over time, if incomplete files become the norm, then lenders and their staff are far less likely to give you good service, do favors for you, or try to help train you. Complete files are key to a long and fruitful relationship with your lender. If you can deliver clean files and, moreover, a lot of complete files, so you're sending your lender a lot of business and they're all clean, then your lender will most likely give you better service and be willing to work out pricing deals for you guys. I've worked for lenders all my life, and I've worked in wholesale for the last 15 years. There isn't a lender I haven't worked for where I haven't seen on the back end how they think about brokers and how they treat brokers. They pretty much all have the same kind of deal. And I come with an underwriting background too, so I've sat around a lot of underwriters. When we hear the name of a broker, we immediately think good or bad. That's just the way it goes. And, you want us to think good, because at the end of the day, if we're tired and we've got one more closing to get out, we've got 3 more loans to underwrite, and now we're working overtime, and we have to meet a quota of some kind, or if we're going to do a favor or not, whether somebody's going to stay and close your loan, or I'm going to take your loan home and underwrite it tonight because I want to give you good service, it's going to depend on who the brokers are. And as an underwriter, I used to walk up to a queue. If I had to take 3 loans home that night, I used to walk up to the queue and pick the loans from the brokers that I knew did a good job processing, and skipped over the other ones. It's just the way it goes. Your lenders on the back end are associating your name with the files, the type of files you're submitting. So you definitely want to protect that reputation and keep it good with your lenders. The loan process can turn out to be cumbersome for all involved and does not give you, the lender, the realtor, or your borrowers a good experience if any of these above issues are going on that I just mentioned. Sometimes lenders can make up the time and sometimes they can't. It all depends on what the underwriter has on their plate that day and what the mood is for everyone involved. This just doesn't work for any of us. We're all working for that referral and repeat business. We should make sure we're systematized so that we all have the same good experience. So, one of the things that you can consider to do, and let's talk about that. Let me just scroll down here. So some things you guys can do, to help avoid all the things we just talked about is, consider becoming systematized and earn that business, is to know your product, know the underwriting guidelines, know the documentation requirements, and submit a complete file. Your goal should be to have the least amount of conditions possible. So there's things you can do. All lenders have product guidelines and representatives that help you research your loan scenarios. Use the tools and services a lender provides to help you understand what your documentation requirements are going to be. If they don't have training, ask for some or find a lender that will train. If your lender isn't providing you training, you need to ask for it. I've been in your shoes. I've had lenders flat out send me a submission form and a website address and basically say go for it. That's not going to help me submit a complete file. And if I want to send a loan to you, if you've got the product or the price I need or want, and I want to do business with you, then you should be willing to train me. And get with the representative or the account executive for that lender and ask for training. Ask for them to walk you through websites. Ask them to sit down and go through products with you. Get that information up front. This is part of a way that you can be systematized so that you can start to learn the product and the service that you're going to turn around and provide, to your borrower and to your realtor. So you may want to choose, 1, 2, 3, 4 different lenders to work with and sit down and do some mega training with them up front so that you understand what you're walking into. Besides your lenders, there are other training sources on the internet. You can use Google. That's a great way to search for mortgage training. I've Googled mortgage training before, and I've made it Utah specific. I've Googled loan officer mortgage training, and you will get a lot of resources pop up for mortgage training. YouTube is another great source for mortgage training. You can do a mortgage training search in YouTube and have a ton of videos. Even my trainings that I record on YouTube, when I'm in there recording and uploading my trainings, I see a ton of other trainings a lot like mine up there. I think that's a great resource. It's free. You've got different perspectives. You've got, layman's terms. You've got people just like you out there training. So I think it's a great source. And I would dedicate myself to at least an hour of training a day on whether it's a new product or a service or a lender guideline or a specific underwriting guideline. I get yourself committed to 1 hour of training a day. They say that if you do that, if you actually read 1 hour a day on your industry, over time you become a complete expert. I mean, that's a lot of training. That's 52 hours, or excuse me, that's 365 hours of training a year. So that's a lot of training, and that's more training than you get going to our required classes for sure. Develop systems. Develop a loan origination and processing system, and follow it every time. Create a McDonald's-like experience for your customers. The reasons big chains and even big chain mortgage companies or big chains like McDonald's, the reason they're so successful is because they create an experience for their customers that happens the same way every time, no matter where the customer goes. So whether you eat a Big Mac in Norway or Japan or Salt Lake City, Utah, it is the same experience for the most part. They're creating an expectation and they're meeting it. So they're creating an expectation that you're going to get that Big Mac that you know and love and is comforting to you, and no matter where you are, you're going to get that Big Mac the same way every time, and you do get it the same way every time, and you are happy about that. That's what service is about, is setting an expectation and meeting it and doing it every time. If you can do that with your realtors and your borrowers, you will get repeat business. And, there's a lot of training, there's a lot of statistics out there. You want to start asking for that referral business early in the loan process, actually before you get too far along, before something goes awry. But get that business referral early, create that experience for them so that they have a good experience every time. And don't be afraid to let your customers know you need time to do your job as well, and give them deadlines. We've talked a little bit in some previous trainings about creating a timeline and reviewing that with your realtor and your borrower. We'll talk a little bit more about it at the end of this. But yeah, don't be afraid to sit down and say, hey guys, I need 2-3 days to process all this documentation before I get it to my lender, so I really need you to have it by this date. Other things you might want to do is designate somebody in your office as an unofficial underwriter, or if you're working in teams, if you have a team of processors, you can rotate a file through your team. Like maybe one team member focuses on the 1003, and asking for initial documentation. Maybe one team member is responsible for reviewing that documentation. And then maybe a third person is responsible for underwriting the loan and making sure the first two people did their job, basically, and asked for the proper documentation, reviewed it, and then asked more questions and got those questions answered before the loan gets submitted. It's what we do in our office. We manage hundreds of loans, and we use a process where the file comes in and it goes to a setup person, and then it goes to a coordinator that puts it together for the underwriter, and then the underwriter underwrites it, and then the closer closes it. So we don't have one person sitting down and, trying to handle the whole loan flow. It's divided out into different sections, and that's something to consider in your loan process, is dividing the process out into different sections, not making one person responsible for the entire loan process because it's huge. And if you have multiple people working on the same loan in a process, you're more likely to catch errors because somebody down the road is going to catch an error. And you can even, you can do it with the Countrywide method. My mom worked for Countrywide for like 20 years, and their little branches sitting around only had 3 people in them. Their branches processed, my mom worked crazy hours, and she came home tired every night, and I couldn't believe the number of loans they were processing. I worked for a local retailer at that time, and their little Countrywide branch out-processed us. They were doing hundreds of loans where, we were doing tens of loans. And it's because they divided the loan flow into 3 sections, and then every 2 weeks they would switch. So 1 week my mom would, for 2 weeks my mom would be like the setup person. And then the next 2 weeks she was the processor person. And then the next 2 weeks she was the underwriter person. So she wasn't always doing the same things, and she was learning all of the different facets of the business. And, they were cranking through a lot of loans just because of how systematized. And they weren't making a lot of mistakes. So, those are some things to consider. Of course, there's other things you can do, with your systems. Make sure you've got some tools to support the systems. Create checklists, conversation logs, status lists, loan timelines, loan flow charts. One thing I do see a lot in my brokers' offices are I'll walk in and there'll be a wall dedicated to loan flow, and they'll have every single loan listed there, and they'll have, basically a visual aid of where each loan is in the process. And you could take that one step further and not just put on that big board where the loan is, but put on that board where the loan needs to be and by when and where it is. So if you've got a submission deadline of the 6th, and it's the 3rd, and you look at this chart, and maybe you've got 3 or 4 loans that are in that same position, you can quickly look at a chart and say, wow, I've got 3 loans that I've got to get into underwriting, in 3 days. So, consider doing those kinds of things, become very systematized. I have training I can help. I have tons of experience. Don't be afraid to let me come in, take a look at your system, and take a look and see what we can do to help you out. The more knowledgeable and systematized you are, the better experience everyone will have. It all starts with you guys. If you're now completing the curriculum that I put together, then you've actually taken a great step towards, how to recognize and understand underwriting guidelines and documentation requirements, and maybe how you can start putting a system together to make that process go smoothly. Okay, so that's the underwriting process and the thoughts of an underwriter. Moving on to closing and funding. Once the loan has been approved and all of the underwriter's questions are answered, then the loan can close. Closing policy and procedures, guidelines vary per lender. One consistency, however, are prior to closing document conditions. Closing document conditions are typically part of your underwriting disposition. An underwriter will issue all of your conditions, including these. You should start working on them immediately. Don't wait until the loan is approved and ready to close. Some of these conditions are for you to complete, and some of them are your lender's responsibility. So we talked about this way at the beginning of the discussion today. Jump on all those conditions, whether they're yours or not, and make sure they're getting done. Work on your prior to document conditions at the same time you're working on your underwriting conditions. Because once everything is cleared, the file will move to a closer who will prepare your closing documents. All the conditions should be signed off at this point. You should make that your policy. Regardless of your lender's policy, I would make it your policy that all your conditions are signed off by the time you go to closing. That way you walk into closing, you sign the closing documents, it's a done deal, you're funding the next day, and it's over. Everything is over. You've met your borrowers and realtors' expectations by funding the next day at a minimum. They probably like to fund at the time of closing, but that's not realistic in every case, in most cases. In fact, it's called table funding when you fund the same time that you close. We only do that if it's required by the state. So, you just want to make it your own policy to have all those conditions signed off and have it be a done deal at closing. No, without any trailing documents. Some lenders do allow funding conditions, and they will allow you to run around and get a pay stub or an LOE or a signature after the loan is closed. They just won't fund. At some point, you just got to say, when does this all end? You got to put a stop date. Imagine if we let all loans have prior to funding conditions. All loans probably would have prior to funding conditions, and we probably would be running around a week or 2 weeks after funding, trying to get conditions handled. That just, it's inefficient. It's not a good experience for your borrowers and your realtors. It actually drives up costs overall. So make it your policy to have all your conditions signed off and done before the loan goes to closing. And then it is like a 2-day process after that. You close the loan one day and you fund the next. When you're putting together, your timelines and working with your lenders and your borrowers, try and work in some margin for error. Everyone makes mistakes. Somebody's going to make mistakes down the line. I'll be the first to admit lenders make them all the time. I make them. I've seen loan officers and processors make them. I've seen realtors make them. I've seen borrowers make them. There's so much human contact in the loan process. It's inevitable. Somebody somewhere is going to make a mistake or just miss something. And I'm talking about, unintended mistakes. We don't mean to. It just happens. And sometimes we can recover and sometimes we can't. The best way to know that you can recover and you're foolproof on any mistake, no matter when it occurs, is to give yourself time, give the loan some room for margin for error. So, you've got to have a couple extra days in case we need to fix something. It's just really important that you guys are systematized and your loans, follow the same process so that you can take all of this into consideration. It's a huge endeavor. Processing a loan is just as big, well, I would say almost a bigger endeavor than underwriting a loan. You've got a lot more moving parts than underwriting does. So I can't stress how tools and systems can help you with your loan flow and get your conditions down to a minimal number. I'll share with you real quick one quick tool that I've put together, and you're going to look at this and, like Duffield, this is a huge checklist. I don't want to use this. It's massive. I've put together a documentation checklist. This one is specifically for VA loans. I've got a general one that you can use on all loans as well. But this checklist, I've got a column over here for required documents. So if you end up using this or something like this, or you develop something like this, put a required column so that somebody can go through and say, okay, this is required, this is required, this is required, and then someone else can go through and say, okay, it's received and reviewed, it's received and reviewed, it's received and reviewed. And so I've broken this out into different categories. I've tried to put it in the same loan flow process. So you've got disclosures, you've got processing items, and then you've got the 1003. These are things that I would have both the loan officer and the processor involved in right up front. QC these 3 categories and, do that up front real quick. And then you can create a process to QC the remaining categories, after you get the initial QC done. So I've broken out credit. I've broken out the employment. I've broken out the income. Broken out liabilities, assets. And I've included documentation requirements for each of these categories, and it's pretty thorough. If I've missed anything, not a big deal, because I've caught so much that if you're using this checklist, you're only going to have a couple of conditions come out of closing. I almost guarantee it. I've broken the collateral section out between documenting the acquisition, the purchase contract, the appraisal, the title report, the different inspections that could be required, all the documents that come with the title report, and then, of course, those are different lender documents. So you can use this checklist. And you guys, I have a Word version of it if you want it. I'm not keeping it proprietary. So if you want the Word version so you can copy and paste or add to it, feel free to let me know and I'll send that to you. Well, that's it. That is the conclusion of our curriculum and this class. Please make sure to check out the other trainings that I have available. You've got information here to my blog. You've got my contact information. I have a ton of other training available. Thank you for your time and have a great day.